All right. Good day. That is Mr. Piniel speaker, and today I will be looking at ES 8. I have a question here, which was the class test based on ES 8. The information that was given is for NW for the 31st December 2010. And it was about plant, which is clearly the historical carrying value, and depreciation is calculated on a straight line method at 20% per annum with no residual, which means that the value of the plan is to be spread over 5 years if we make 100 divided by 20. And land is clearly at historical cost price, and they say the inventory is before I move to inventory, which means there is no depreciation on land. It's clearly at cost. Okay. Inventory here is valued at the lower of cost or net realizable value, the lower of the cost or net realizable value, and the inventory is valued on the first in first out basis. And they say during the compilations of the financial statements for the year ended 1st December 2010, the following changes or collections were made in the accounting records, where management decided that it would be better to change to the weighted average basis to account for inventory, as it will be better represent the current economic environment. If you look back there, it's based on ES 8. ES 8 is about the changes into the accounting policies and estimates and collection of error. And here, these people decided that they will change their policy from FIFO to the weighted average basis. So there's a change of a policy here. If we are looking here, it means that there will be a change of a policy from the first in first out basis to the weighted average. And they say that some information was made available with regards to the value of inventory over the past few years as at 1st December for each year. So that is the information here. Based on FIFO, we are given the closing inventory for 2010 based on FIFO was 200, weighted average 300, and then for 2009, based on FIFO, it's 210, and weighted at 250, and for 2008, 240, and 205. And then for 2007 it was 300 based on FIFO and 280 based on the weighted average. Right, so they say it was also noted that included in the fixed asset register under planned is a piece of land, and after further investigation it was found that the land was purchased on the 1st of January 2007 at a cost of 200,000, and at acquisition it was already incorrectly capitalized to plan, which means the amount of 200 has been included into the land into planned since 2007, and it has been depreciated to since 2007. And remember there where we come from, we noted that land is not depreciable, which means there has been an error in the prior year, and they say ignore the tax implication, and the requirement was to show the above mentioned adjustments or corrections in the following notes. What they ask us to do here, if we look at our accounting records, what we are given, we are asked, is notes. We are asked notes. So you can be asked about to prepare journals. You can be asked to prepare an extract from the statement of financial performance, or extract from the statement of financial position, or to prepare from the statement of change in equity or cash flow. They can ask you a lot of extract, and the extract that we are asked here is from the notes to the financial statement, where notes concerning the prior period error and the change in accounting policy. Let's see the answer. Let's go to the answer. Let's solve the Zoom here. All right. We start off by collecting the prior period error, and we say that was a land at the cost of 200, which was erroneously included in plant, and the notes to the financial statements for the year will be as follow. So we make it just 5. The 5 there is just an example, that let's make it 5. And there's the collection of error, and we say we start with the note like this to say during 2007 land of 200,000 was incorrectly included in planned. Because with these notes, just to explain what is visible in the books, because there might be some changes in the books there, and we have to explain what happened in the notes. That's why we are explaining that there were land which was incorrectly included in planned since 2007. And in the note, we also have to show the effect on the statement of comprehensive income, where we have to calculate there that it has been a depreciation, which is 200 times 20%. It has been straight line depreciation on plant, in which this 200,000 land is included, which is 40. And if it's 40, it means that for the current year, the effect on the statement of comprehensive income is that we have to add back this depreciation. That's why you can see there we add back a depreciation of 40,000, and we saw an increase in profit of 40,000. And also saw the effect on the statement of financial position, increase or decrease on asset, which means that if we are to restate the figures in all those years, this has been 40. If you go back to 2007, where there was a depreciation of 40, accumulated depreciation with respect to that 200,000, it was just 40. That's why we are adding back that 40 to PPE. In 2008, because we have depreciated 2007 and 2008, that amounts to 80. That's why we are adding back 80 to PPE. And in 2009, we have depreciated for 2007, 8, and 9, 3 years. 40 times 3, that is 120. This is where the 120 you can see is coming from. In 2010, we have depreciated that same amount for 10 years, which means there has been an understatement of 160. So we are adding back that 160 in 2010. And we saw the increase or decrease on equity is still the same thing, because we have been experiencing a decrease in profit because of the depreciation, that is including the depreciation of the 200,000 plan that's included in the into the plant. Therefore, the balance we have in 2007, it means that it need to be increased with 40. Then in 2008, it needs to be increased with 80. because of the effect of 40 of the balance from the prior year that has been down with 40 into 27, and another current year depreciation of 40. That's where we take that 80, you can see there. And then in 2009, the balance has been down with 80 since the 31st December 2008, and another depreciation in 2009 with respect to that 200, and this means 80 plus 40 is 120, and it's the same as 2010. That's how we are going to increase our balances for the years, for the make the comparison easy. Okay, all right, that is it with the prior period error. The prior period error, that's how we need to correct it. Let's see for the significant accounting policy. This one is fading. What had happened? Let's wait. All right, and with the significant accounting policies, as it is usual, it used to be note number 2, and what's happening there, we are saying that significant accounting policies, and this have to start at as it has to be started with. If we go back to the conceptual framework and the way we were taught in the this chapter for the presentation of financial statements when it comes to the notes, we say the following are the significant accounting policies, including measurement basis which have been applied by NWU Limited, and these accounting policies has been applied consistently except for a change in accounting policy. You know, the policies need to be consistently applied for comparison purposes so that we are able to compare this year's result with the past year's results or with the same entities in the same industry. And they say this except, we include an exception there, that there's a change in accounting policy that involve inventory. All right, 2.1 there. Okay. 2.1 there we start with inventory. Then we are saying that inventory has been measured at the lower of cost and net realizable value. It has been based on FIFO, as you can see on the information given in the question. And then however, during the 2010 the company has reverted to AVCO. It has changed to AVCO, and we have to provide a reason why it has changed. We say it's deemed to better represent the current economic environment, and we put another note, right? And then we move to plant. We have to include all what we are given in the significant policy, because we are just asked to prepare about the significant policy. And then we are saying that the plants are carried at historical carrying value with a 20% knowledge dual value straight line depreciation. That's how it has been measured. And then we move on to land. We provide that land is carried in the historical cost price. And we provide another note here where we say during 2010 NW Limited has changed its inventory policy from FIFO to AVCO, and the following effect was effective. We saw the effects on the opening inventory and the closing inventory. See what will be the opening inventory, what will be the closing inventory. You can see the changes when we applied the weighted average. You see that when we apply the weighted average, the closing inventory in 2007 will be 300, and the closing inventory in 2007 will be the opening inventory in 2008, and the list go on the way we are given it in the question. Okay, and there's a change in retained earnings here with respect to the change in the measurement base of inventory, and it means that if in 2007, in that year, the closing balance with FIFO was 200, and we increased, that is in 2007, and we have increased, because it's 200 with FIFO, but it's the new base, which is weighted average, it's 300, which means that the profit has increased. Because if we are calculating to say how do we calculate the cost of goods sold, we say the opening inventory, we add the purchases, and we take out the closing inventory. And it means that if closing inventory, which we take from the cost of goods sold, is increasing, it means that the gross profit is increasing, and if gross profit is increasing, profit is also increasing. That's why you can see the retained earning 2007 has increased with 100. And then when it comes to 2010 then, when it comes to 2010 then, there is, in 2010 we can see that 2010 there. Okay, all right, that's it. That's how it's supposed to be checked, and you saw the effect. So if you take the new balance, we take out the old balance, we will see the change in the retained earning, which means that if the new balance, new closing balance is higher than the old closing balance, it means that the retained earning will increase. And if the new balance is lesser than the old closing balance, it means that retained earning will decrease. That is it. Thank you.